Okay, onwards then. And in fact, joining in on the show now to talk about strategies in this market, Amit Nigam. He's a head of equity at Peerless Mutual Fund. And we've also got BGC partners, Michael Ingram, who's joining in. Gentlemen, both of you, thanks so much for taking time out for us. Michael, let's talk about, the big event right now that everybody is looking out for. And that's really the odds of a Brexit. Overnight talks, we don't have a solution on the table yet. How hopeful are you?
Probably too close to call at the moment. If the polls are to be believed, it's very, very finely balanced. A lot of airtime has been devoted to the recent YouGov poll, which showed, I think, a 9% margin in favour of exit. Given the recent poor showing of pollsters, perhaps we should take this with a pinch of salt. But you have to take on board that one of the things that has galvanised the no vote historically has been relatively poor performance from the UK economy, and the performance of the UK economy has softened somewhat in recent months. Also, the immigration crisis, the migration crisis that we're seeing in continental Europe, has pulled back a little bit over the winter months, but is going to go to warp speed in the spring. So that's going to be hitting the headlines increasingly over the months ahead. And of course, we've got our old favourite subject, things like political instability in Spain, in Portugal, and of course Grexit yet again bubbling away. I can't think of anything more likely to galvanise the outvote than the prospect of Germany bullying Greece over the summer months. So, if you had to ask me which way I think it'll flop, I think we could vote for an exit. But of course, at the moment, we don't actually know what we're going to be asked to vote on. The substance of any agreement has still to be thrashed out, and neither of the in or out campaigns have yet properly geared up.
Amit, let's talk about the mood here at home. And, this week's been packed with a bunch of investor conferences. You yourself have been attending quite a few. What's the sense that you get when you interact with a bunch of, fund managers and money managers?
The broad sense that we are getting is that in terms of business, we are still not seeing things pick up at the business level, at the market level. Because we are seeing two successive failures in monsoons. So whether I look at products like consumer FMCG products, consumer durable products, everywhere we have seen a slowdown. And over and above that, what we are seeing is that because of the huge commodity meltdown globally, somewhere the corporates in India have been forced to pass on this price benefit to consumers. And as a result, the top line growth for a lot of these companies has actually become difficult. In that scenario, the profitability growth for a lot of corporates, especially the ones which run with high fixed cost element, is actually under pressure. And that's what we have been seeing in the last 5 quarters. And the sense that we get now is that in some pockets, we are seeing probably bottoming out process in place in terms of the demand. And hopefully if the monsoon is good this year, and there are a lot of reports which talk about the La Nina effect being set in terms of the monsoon, we should be able to see demand and therefore growth for a lot of companies pick up later in the later part of this year.
Michael, let's talk about what's happening in the US. Do you believe that the current economic environment is conducive for the Fed to go ahead and actually tighten rates? How many rate hikes do you expect to come in this year?
Well, certainly, I've never bought into the Fed's own dot plot, which was, as of December, was an implied 4 rate hikes. I think we're actually looking at a 2 hike year in 2016, and we may get further clues on that when we hear from Loretta Messer at the Cleveland Fed later on today. She is, of course, very much a hawk. I don't actually buy into, the current market expectation, which only ascribes something like a 30% probability of a single rate rise during the course of the year. I accept that economic conditions are soft and getting softer, and in fact I've been pointing this out for a very, very long time. However, I think that the diagnosis of lower rates for longer, negative rates, etc., is simply misdiagnosing the economic problem. In fact, I think central banks and and these policies are actually become part of the problem rather than the solution. The problem is, and was always, overinvestment leading up to the financial crisis. There should have been a proper balance sheet shakeout in the years that followed. That wasn't allowed to happen. The market hasn't been allowed to clear, and that's why you have low investment, low productivity and no inflationary traction. But that is a very, very tough road to tread. We need to have this liquidation. It requires policymakers to basically admit that they're wrong. It requires the rich to get poorer on both an absolute and relative basis. And, do turkeys ever vote for Christmas? Not that I've heard of.
Right. I mean, let's talk about strategies then in a market like this. And, you've got a bunch of fund managers making a case for how there is value to be found, especially in some of the beaten down large cap stocks. What is your call on valuations as far as the Indian markets are concerned? And are you sort of going ahead and deploying cash? Would you suggest that one buys in maybe small lots right now?
Sure. I think valuations have definitely corrected, at least when I look at prices. We have seen the markets correct by almost 20% from the peak levels, and some of the stocks would have corrected far more. But what has happened over the last 12 months, we have seen a lot of earnings cut and downgrades in the companies, and therefore the valuation correction is not to the extent of the price correction. So though if you were to ask me, compared to last year, about 12 months ago, the valuations have come off, but not to the extent that you are seeing in the prices. Now, having said that, if my outlook for growth over the next 3 to 4 years seems to be in place, because once the bottoming out process happens, the inflation starts picking up, the pricing power for the corporates comes back, demand also comes back, as I was telling you, then we should be looking at valuations far more favorably. And therefore, my suggestion is that we should be looking at such corrections as opportunities to invest in equity, and especially in equities of those companies which have been doing well in terms of the business, which have pricing power and have a control of the consumers.
Michael, let's talk about oil prices. And this week it's been all about the moves that you've seen, and all about, the verbal interventions from Saudi Arabia, Russia, Venezuela, even Iran. What's the outlook for prices? Because, there was hope that somewhere a bottom was in place, but they've gone back to their losing ways today.
I still think we trend lower. I mean, at the end of the day, we've probably oversupplied to the tune of 2 million barrels per day. It's very, very clear that we're not going to see OPEC move. It's very clear that Russia's going to merrily pump as much as possible. And it does seem that the thing that was supposed to help clear the market, this, if you like, capitulation of US shale, isn't really happening. US oil crude production peaked in the summer of last year at about 9.6 million barrels a day. It's now down to about 9.2. But it's been far more durable, resilient than anybody expected. And of course, the thing that is in the back of my mind is, how are US politicians going to react to the prospect of letting their domestic oil industry, with all the energy security implications, go to the wall in a presidential election year? So I'm fairly sure that the US policymakers there, politicians there, are going to want to see a worked solution to the current slump in oil price. And finally, in terms of just how low could it go, of course, that's major speculation. For me, again, the issue in this situation where you have certainly oversupply and demand clearly isn't going to come to the rescue anytime soon, is just at what point do we run out of physical storage? Bob Dudley, BP, within the last week talking about filling swimming pools with oil by the end of the year. Well, if that's where we're going, and we seem to be going in that direction, then, why can't we have $20 oil or $10 oil?
Right. Let's also talk about, fresh stimulus from central banks. That seems to be fueling the markets right now. Do you believe that a lot of it is now already in the price and in some sense being baked in?
Well, I think an enormous amount of additional stimulus is in the price. Of course, I've mentioned earlier that, the Fed dot plot is looking at maybe 4 quarter point hikes during the year. I mean, there is a small possibility being priced into markets of even a rate cut, a similar situation even in the Bank of England and the European Central Bank. But the question really here shouldn't be what is in the price or what these central banks can do. My question, I think, probably more pertinent is what can they usefully do? And no one has convinced me, and I haven't seen any evidence or research to support this, that negative interest rate policies, for instance, and we've got this inane debate about just how negative we could go, actually does anything for the real economy. It is clearly a cost on the banking system. It does nothing to support credit growth. Ergo, it does nothing to support the real economy. And in terms of its impact in perhaps lowering the currency, this issue of introducing effectively negative carry and deterring currency speculators, well, we're perhaps getting towards the end game on that as well, because of course it spectacularly misfired for the Bank of Japan within the last 2 weeks.
All right, Michael, Amit, gentlemen, both of you, thanks so much and have a great weekend. Let's take a breather here from all the market chatter and take it across to Krishna Kumar, who's here to talk to us about all the big national stories.
Thank you, Tanya. Time now for Nation Now and all that's making